Good morning, everybody, and welcome to another episode of Environmental Social Justice. I'm your host, Wendy Nystrom, and today's special guest is Jordan Haedtler. So Jordan is a climate financial policy consultant based in Duluth, Minnesota. Welcome to the show, Jordan.
Thanks for having me.
Anytime. So could you explain what a climate financial policy consultant is?
Sure. The climate change has been conceived of, I think, traditionally as an environmental crisis and as an existential crisis, which it certainly is. But in recent years, it's increasingly being understood as an economic and financial crisis as well. For the past few years, I was working on the Hill in Congress, including for the past 3 years for the House Financial Services Committee. And the portfolio that I covered on the committee was all things Federal Reserve, both monetary policy and financial regulation, as well as insurance policy. And then, especially once the Biden administration took office, the oversight of a climate risk supervision framework by the Fed and the other federal financial regulators. And what I've been doing for the past year plus is taking that framework and trying to apply it to the state legislative and regulatory context. And so we'll sort of get into it in a bit, but essentially, there are all these financial stability problems, periodic financial crises. The one that most people remember all too well is the 2008 crash. And climate change, as it evolves and intensifies, is increasingly being understood, including by some of the regulators responsible for monitoring and addressing those risks, as presenting another financial stability challenge that could manifest in a 2008-like crisis.
I mean, to say you're an expert in this is an understatement. You have worked in Washington, D.C. for years. You've worked in policy for many years, financial policy as well as insurance. And tying all that together, you are seeing, a lot of people are now recognizing the fact that climate change is affecting our insurance. And insurance has also often been called the canary in the coal mine with respect to climate change and how it will affect the financial institutions. You are pretty much at the forefront of calling this out and bringing a lot of attention to this with your background. And one of the things that we're going to focus on today, and I'm an insurance gal. I spent my entire career in it, and I'm an environmental person. So you're kind of in one of my favorite places right now. And when you're talking about insurance, you're saying is the primary channel for climate risk being transmitted to the financial system. What is the simplest way you could relay that to someone who doesn't understand finance or insurance or how all of this is intertwined?
Sure. Insurance companies are essentially these massive financial conglomerates.
Yeah.
I think people understand that they pay their insurance company every month in premiums, and that those premiums are meant to protect them if something goes wrong. But what insurance companies are doing with those premiums is investing them in financial markets. And insurance companies refer to those investments and the net worth of the investments that exceed the losses that they pay out as float. And so insurance companies are in many ways very much financial in nature. And the way that they expose the financial system to financial stability risks is that there's what's known as the exposure channel. That is, as climate change intensifies and we see more and more floods and fires and other climate disasters, insurance companies are paying out more and more in losses. It's estimated that there were $120 billion in damages from climate risks, climate disasters, just in the first 6 months of 2023. And so they're paying out those damages. The losses that they accrue are exposing those losses to some of the other financial market participants that insurance companies have a relationship with. And that means banks, hedge funds, private equity firms, all sorts of banks and shadow banks, as they're known, have investments in the insurance sector. And when insurance companies take on huge losses, those other financial market participants are exposed to those losses. The other primary channel that regulators have expressed concern about is called the asset liquidation channel. And what that means is that, as I mentioned, there's this float out there, right? Insurance companies have all of these investments. And if they suddenly have to pay out damages in response to some really catastrophic events, more and more we're seeing them, and there's an upside of there's increasing forecasts that you could see a 1 in 100 year event hitting Miami and Houston in the same year. Things that previously seemed unthinkable or just really, really low tail events, they're growing more and more likely. And it's estimated that if that were to happen, category 5 storm hitting Houston and Miami within a short time period, that would be $500 billion in exposure to the insurance sector. And if that were to happen and all of a sudden insurance companies have to pay out huge damages, they're going to have to sell off a disproportionate amount of that investment portfolio that they're collecting over time from your premiums. And that could place steep and sudden downward pressure on a whole host of assets across the financial system. So essentially, a bunch of stocks and bonds might see their value decline in response to this catastrophic event that really has nothing to do with the value of Pepsi or whatever other company.
It's a chain reaction. They're all connected.
And so that's called a fire sale. And it's happened in financial crises in the past. And there's a concern that a major climate catastrophe or a series of them could cause that to happen in the insurance industry.
And that is, you said a lot, and I just wanted to revisit much of what you said, because it's extremely important that people understand the fact that climate change is affecting our weather. We're getting more severe and frequent catastrophic storms, so they're happening more frequently and they're stronger. So it's highly likely that we will have something happen in Florida and Texas simultaneously. Palm Springs got hit by a tropical storm a couple months ago. That would have never happened in the past. That was an extremely unusual situation.
Right.
So these are happening. And as you said, as a result, these insurance companies, they like to be profitable. They have their investments. When they have to start paying out losses and it's more than what they've reserved to pay out those losses, then they have to start selling some of their assets, which is that chain reaction you mentioned that will affect the stocks and bonds and everything else as part of that fire sale. So this is damaging to our entire financial structure. And one of the ways that we can deal with that is addressing climate change and house hardening and mitigation strategies, or stopping something before it starts, which is something else you and I have discussed. And just folks, we're going to have a follow-up with Jordan because he's got a wealth of information on this to share with us as well. It's just too much in one episode. But talking about the insurance aspect and the financial aspect and how we're looking at things, let's talk about Florida and California real quick, because they have state-sponsored insurance funds that were never really meant to cover the climate issues. So Florida, the flooding, California, the fire, those funds were actually never meant to do that, but that's what they've become. And how is this dangerous?
Well, that's right. Many states have over the years set up insurers of last resort. And these are commonly called, in most states, California being one of them, these are called FAIR plans. And what this means is it's sort of a form of private insurance that the state sets up in cooperation with state-based insurers that will ensure that policyholders have the option in areas which, for whatever reason, have not been able to get insurance. And historically, it was usually based on redlining or racial discrimination. And that was the reason why some communities struggled to obtain insurance. And that's actually the history of it in California, is that the FAIR Plan was set up because many communities in Southern California were being discriminated against. And the risk has evolved over time so that some of these insurers of last resort, which offer bare bones plans to cover homeowners in areas where insurance companies are not offering many policies, have seen more and more pressure and have been needed and relied on more and more regularly. And Florida set up its insurer of last resort, which is called Citizens, after Hurricane Andrew caused a lot of disruption back in 1992. And there were a number of insurers that went bankrupt. All of a sudden, there were numerous markets throughout the state of Florida where all of a sudden you had homeowners really struggling to obtain insurance in areas where they'd previously been insured. And so Florida set up this system called Citizens, which was the sort of state-backed insurer of last resort. Well, fast forward to the present day, and Citizens is now the predominant insurer in the state of Florida. It is now, there's 1.5 million policyholders who have a policy through Citizens, and it's the single largest insurer in the state of Florida. And that's unfortunate for a number of reasons, one of which is that the policies offered under these insurers of last resort usually aren't very good and are very expensive and don't offer the kind of coverage that homeowners typically need. And another reason is that in Florida specifically, the law requires that all policyholders are sort of on the hook in whatever event, in the event that Citizens is exposed to losses that exceed what Citizens has taken in premiums. Well, more and more that is going to be the case in the years to come in the state of Florida. And so there's a concern that not only do you have more and more Floridians relying on these Citizens policies, but you're going to have even people throughout Florida who aren't Citizens homeowners paying these surcharges every year when Citizens pays out more than it can take in.
Yeah, and that is a specific to Florida. and California, it's very similar but a little bit different. It is an insurance of last resort, and it was designed for, as you said, in response to discrimination, but it's become the biggest wildfire fund in California, and that was never the intent of that program. And it is oversubscribed, meaning a lot of people are relying on that FAIR Plan for their insurance. And instead of the citizens of that state paying into it and being on the hook for it, as you said, in Florida, it's the insurance carriers. So if you want to be an insurance carrier that does business in the state of California, you have to act as the reinsurer for the FAIR Plan. So if they don't have enough reserves or enough premium that they took in to pay out a catastrophic loss, then they turn to the insurance carriers and say, pay up. And for some of those carriers, it could bankrupt them if there's a devastating loss, which is a dangerous thing. Another word, I'm going to reuse the word dangerous again. We're kind of in a dangerous spot right now of a chain reaction that could have catastrophic results in our financial institutions. Now, what Jordan's also working on, which is super cool, is he's dealing with a federal level response. So you're dealing with the federal insurance office, you're dealing with people in that level of government who can possibly provide a response or an answer or some kind of guidance. So what's the latest on that? Maybe give people an outline of what the federal insurance office is and how they work with the rest of the states.
Sure. So, well, it's necessary, I think, to take a step back and talk about, first of all, the federal regulators and how they're sort of setting up this climate financial regulatory framework, and also some of the peculiarities about insurance within that broader framework. So first of all, after the 2008 crash, Dodd-Frank created a few different agencies to make sure that something like that was less likely going forward. And one of the agencies that he created was the Financial Stability Oversight Council, which is FSOC. And the acronym FSOC refers to a consortium of federal regulators. The Treasury Secretary, Janet Yellen, is the chair of FSOC, and she sits on it with the SEC chair, the Federal Reserve chair, the FDIC chair, and then all of those banking and financial regulators that cover the whole financial system. And what their responsibility is to monitor and coordinate action as financial stability threats emerge. And soon after taking office, President Biden issued an executive order that directed Secretary Yellen, as the chair of FSOC, to evaluate climate as a growing threat to the financial system. And in October of 2021, the FSOC put out a report that detailed that climate change is in fact an increasing and emerging threat to the financial system, and began to put in place some guidelines for how regulators should respond to this threat. And I won't go into all of the details, but it's necessary also to highlight the Federal Insurance Office as one of those agencies that Secretary Yellen encouraged some response from. So the Federal Insurance Office was also created through Dodd-Frank. And it's important to note that it is not a regulator. It is actually just a data collection agency that monitors and is empowered to seek information and share that information with other regulators. And the reason why that is that in the US, there's a very unique form for regulating insurance. Basically, federal regulation of insurance is preempted through a law called McCarran-Ferguson that Congress passed in 1945. And so we have a state-based system where state insurance commissioners are the primary regulators of insurance companies based in their state. But that doesn't mean that there is no role for federal regulators. The FSOC, as it has flagged insurance as a risk worth following, particularly when it comes to climate and the overall safety and soundness of the financial system, has directed FIO to evaluate this and use their data collection powers to analyze climate as a financial stability threat. And earlier this year, back at the end of June, the Federal Insurance Office, FIO, put out a report that had a set of recommendations for state policymakers for how they can fill gaps in state-based insurance regulation.
You know, I just want to give people an idea why the data is so important, because typically with insurance, normal insurance, so work comp, your auto, property casualty, things like that, they would look at historical data. You know, the past 10 years, 20 years, 50 years, 100 years, what's the trend? What do we see happening? With climate change, this is new. This is new data, and we need to actually start modeling forward, looking what we can forecast to happen in the future. And a lot of states have adopted it, a lot of states have not. And each state commissioner, I think they do a fantastic job of regulating their insurance companies in their state, making sure they're, not corrupt, not doing the wrong thing, but doing the right thing. But with respect to this climate change being an overall encapsulating event, I personally think it really does need that federal insurance office to get involved and help regulate how we look at this risk, how we forecast for this risk, the data we use, because they have a massive amount of data. And it's my understanding from the insurance industry, insurance carriers aren't going to share their data with people, with regular people, and say, oh, look at our loss runs. They're not going to do that. but I believe the Federal Insurance Office would have access to that. So they do have a wealth of data that could be very beneficial for us, basically managing this risk properly.
That's right, and it's worth, and really is a very important report to read. Not everyone probably spends the same amount of time reading reports from FIO as I do, but FIO's set of policy recommendations for state policymakers released this summer, it flags some really critical gaps. And just to list one example that's pretty alarming. So the state insurance commissioners, one of their more important responsibilities is setting capital requirements, which are rules for making sure that insurance companies have sufficient capital on hand to be able to make their to fulfill their obligations to their policyholders in the event that there are needs to pay out damages. And actually, the risk-based capital formula that is used to set these capital requirements excludes wildfire risk. And that was one of the major flags that FIO issued. They said, this is obviously something that needs to change. And, and so that's why FIO's report is so important, because although it's very wonky and uses a lot of jargon and isn't exactly the sexiest topic that we could read about, if you really read it and go through it and understand some of these gaps, they're really glaring and very concerning.
It's very, I mean, as you said, it's not the sexiest thing in the world, but this is important information that is life-changing, literally life-changing for some people.
Right, right.
And you're actually working, and I'm going to segue into hopefully getting you back in a couple of weeks. You're working on some remarkable papers and write-ups. Is there anything you can share preliminarily? I know there's a lot that hasn't been published yet, but maybe to whet people's appetite for when you come back.
Sure. So there's a couple of letters that we're going to be, that I've been working with a number of advocacy organizations to send later this week, because this is a very critical time period for both the federal and the state regulators. We're going to see a lot of action in the coming week. So the FSOC is having an upcoming meeting. It's actually happening this Friday. And it seems very possible that they will finalize during that meeting 2 pending rules that they issued earlier this year. One of them is set a new sort of analytical framework that all of the FSOC regulators adhere to when sort of defining what the threats to the financial stability of our system are. And then another one is the new guidance that they're putting out to identify and designate systemically important financial institutions. And in the wake of the Dodd-Frank legislation, in the wake of the 2008 crash, there was a lot of effort put toward, basically better identifying how non-bank financial actors, insurance companies, private equity, hedge funds, contributed to that crisis and needed to be subject in some cases to enhanced regulatory scrutiny. And during the Trump administration, all of the insurance companies and non-bank, sometimes they're called shadow banks, that had been subjected to that new designation, systemically important financial institutions, SIFIs, shed that designation. So as a result of that, you have, for instance, Prudential, this large, complex, and arguably systemically important insurance company, has as its primary regulator the New Jersey Department of Banking and Insurance. And there are some questions as to whether the New Jersey Department of Banking and Insurance has the adequate resources, capacity, expertise, and even legal authority to look at the whole range of Prudential's activities. And so what this letter that we'll be sending to FSOC later this week says is essentially, make sure that you're integrating climate risk and climate risk in the insurance sector into these new guidelines that they're likely to be finalizing later this week. And we spell out in that letter some of the problems that we're seeing, the insurance market disruption that is taking place. And we also mention and cite in particular some of the comments that regulators themselves have been making. A few months ago, Treasury Secretary Yellen actually said that one of the major concerns that she has when it comes to insurance is the protection gap. And that is the fact that as climate disasters become more and more costly, insurance companies are actually not even covering all of the damages. And many homeowners do not even have the adequate coverage to make sure that they're protected. She estimated that there were $165 billion in damages in 2020 from climate disasters, and that only 60% of those were covered. And that can have spillover effects through the rest of the financial system, through that same exposure channel that I mentioned earlier, where banks and other financial entities are going to be kind of left holding the tab from the economic damages that come from these disasters and the outcome of, and the fallout from businesses and homeowners not having adequate or not even having any coverage at all in some cases when these disasters strike. And so in this letter, we sort of describe the trends that we're seeing and how the problems that the FSOC regulators, including Yellen, have identified in their case are getting worse. And we also question whether state insurance commission offices have the adequate resources or even legal authority in some cases to completely fill some of the gaps that the Federal Insurance Office highlighted. And where there are these egregious problems like wildfire risk not being included in capital requirements, I think it's incumbent on some of the experts and regulators who exist at the Fed or Treasury or other agencies to be providing some of their expertise to make sure that those gaps are filled.
The work you're doing is so extraordinarily important, and just to overly simplify what you said, we have a chain reaction of events that could potentially happen that could be devastating to the financial stability of this country, because we have the insurance carriers and those shadow banks, as you call them, or non-financial institutions, and they hold a lot of equity. And we have climate change and wildfires and floods and hurricanes and you name it, that could be the igniting point or the powder keg that could set all of this into motion. As you said, you kept referring to 2008 when we had the financial crash in 2008 based on housing, basically, or mortgages. No one really saw that coming. And now we have another thing where we see it, and people like Jordan are researching it and writing about it and studying letters about it. This is why it's so important, the work that Jordan is doing and getting that messaging out there, is you see what's on that horizon and you are writing, being vocal about it, getting that information out there so people understand. And yes, we do need the Federal Insurance Office to be taking the reins and leading this charge. Definitely looking forward to part 2 of this, especially after the papers are out and you can talk more in depth, hopefully keeping it simple. But how can people get in touch with you? Because I know there's going to be a lot of people that are going to be interested in following you and following up on the work you're doing.
Sure. So, you can connect with me on LinkedIn. I'm also available over email. Probably the best way is just to go to my website, which is jordanhetler.com. That's JORDANHETLER.com. HA, E as in Edward, D as in David, T as in Tom, LER. It's a very difficult name to spell, so I'll spell it out that way. Just jordanhaedtler.com, and there's a few papers that I've written listed there, and then email contact is just shoot me an email via my website.
I've actually gone to your website. It's extremely simple to navigate. Even a dummy like me was able to figure it out pretty quickly and find all the information, find your papers. So highly recommend checking out the website. But also LinkedIn is a good resource as well, because you post everything on LinkedIn as well, and you're very active. So guys, please check out Jordan, the work he's doing. This is very important that we address this now, that we work on it now, and that we respond now, because talking about it and hypothesizing about it, that time's over. Mm-hmm. We need this to actually start taking shape and being in effect. So Jordan, thank you for your time. I'm always grateful for, I know how busy you are. Looking forward to you coming back. We'll set that date soon.
Sounds good. Looking forward to it also. Thanks, Wendy.
You guys take care. I'm Wendy Nystrom, a host with Environmental Social Justice. Jordan Haedtler, thank you again. You're doing great work. Take care.
Thank you.